Welcome to Middleway News. We provide the latest news highlights and summaries each day to give you a quick snapshot of what's happening today and why.
Please note that all of the information contained herein is for informational purposes only. Nothing herein shall be construed to be financial, legal, or tax advice.
This is a summary of the YouTube video titled, "In the Next Stock Market Crash, How to Profit" by Graham Stephan. If you like this summary and want to hear more, check out the full video at Graham Stephan's YouTube channel. See the link in the description. The presenter, Graham, addressed the possibility of another market crash in the stock market, despite the record-high stock prices and the euphoria surrounding them. He outlined the historical stock market crashes, emphasizing that none of them have resulted in a complete loss of investment. Graham explained the distinctions between stock market corrections, bear markets, and stock market collapses. He emphasized that corrections are common, occurring every 16 months on average, with an average 15.6% drop lasting for 71.6 days. On the other hand, bear markets, occurring every 7 to 10 years, involve an average drop of 33% over 363 days. Graham presented the analyses of economists John Husman and David Rosenberg, who raised concerns about the current market trading levels. According to Husman, non-financial stocks are trading at levels similar to the extremes of 1929 and 2001. Rosenberg echoed similar sentiments, emphasizing the stark contrast between the S&P 500's 32% rise in the past 12 months and the 4% increase in corporate profits. To prepare for a possible market downturn, Graham outlined strategies. First, he stressed the importance of maintaining a 3 to 6 month emergency fund at all times to cushion the impact of a market drop. Second, he advised diversifying investments across multiple sectors and companies to reduce risk. Graham concluded by underscoring the significance of viewing investing as a long-term plan, especially for young investors. He highlighted the historical success of a 20-year holding period in the stock market, where no negative results have been recorded. Normal volatility throughout the markets is extremely common. Since 1920, the S&P 500 has, on average, seen a 5% pullback 3x per year. Market corrections are also fairly common. On average, a 10% correction happens every 16 months, and throughout the last 20 years, a 10% drop has happened 11 times. The bear market, which is a 20% 39.9% decline, typically occurs every 7 to 10 years. When this happens, stocks drop an average of 33% over a period of 363 days. The stock market collapse, more than a 40% decline throughout the index, has happened 4 times in the last 120 years. Notable incidences were in 1929, 1970s, and 2009. The economist John Husman makes the argument that non-financial stocks are trading at levels that haven't been seen since 1929 and 2001, indicating a likely return of around 95% annualized over the next 12 years. According to David Rosenberg, the S&P 500 is up 32% in the past 12 months, while corporate profits rose just 4% in the fourth quarter, suggesting that the gains can't be attributed to improvements in earnings results. Instead, the market is going higher due to a better-than-feared economy, significant jumps in earnings estimates, and the expectations of lower rates. Keep a 3 to 6 month cash savings. This way, you won't need to sell investments to pay for your living expenses in the event you lose your job, your income slows down, or something unforeseen comes up while the market is low. Diversify your investments. The more you spread out your money, the more you reduce your risk and volatility. Continue the long-term plan of DCA, dollar cost averaging. This is based on the principle that continuing to buy, regardless of market conditions, and sticking to your long-term plan is the best approach. Don't panic sell. An investment in the S&P 500 of $10,000 over the last 20 years would have grown to $64,000 only if the money was consistently invested. Missing the best 10 days diminishes your return to $29,000. Keep consistent income. You want to make sure you have some consistent income to either continue buying in or paying your living expenses, so you don't touch those investments and sell when you don't have to. Only invest long term. A few years is not long enough to ensure that you'll actually make money. So, the shorter your investment time frame is, the less likely you should be invested in something that could drop in price.
We believe in having cash, and there have been a few times in history, and will be more times in history where if you don't have it, you don't get to play the next day. I mean, it's just it's like oxygen. It's there all the time, but if it disappears for a few minutes, it's all over. So,
thank you for watching the Middleway News Daily Update.
Thank you for experiencing today's Middleway News Daily Update. We hope you enjoyed today's top news highlights and summaries. Be sure to check out our other Middleway News services, products, summaries, updates, videos, podcasts, and more.